This man made $2.7 billion when everyone else lost their homes in 2008. Right now, he just placed $1.1 billion against you. Yes, you. If you own Nvidia, if you own Palantir, if you have any AI stocks in your portfolio, Michael Burry is betting you're about to lose everything. And over the last 3 days, his bet already worked. $685 billion vanished from the market. So here's my question for you. How much are you willing to lose when he's completely right? Because here's what nobody's talking about. Burry doesn't make small bets. When he puts down over $1 billion, markets freeze. $30 trillion in market cap holds its breath. And this time, he picked the two companies that symbolize the entire AI revolution. If they fall, the whole narrative collapses. In the next 25 minutes, you're going to understand why Burry calls AI bigger than the dot-com bubble. You'll see the 3 numbers in Nvidia's reports that terrified him. And most importantly, you'll hear why the CEO of a $470 billion company called Burry certifiably insane on live television. But first, you need to know who this man really is and why when he bets over $1 billion, the entire financial world stops moving. Michael Burry, 2005. The housing market is at all-time highs. Everyone's buying homes. Banks are giving loans to anyone with a pulse. The American dream is booming. Burry looks at the same numbers everyone sees and comes to a different conclusion. He places $1 billion against the entire housing market alone. His investors think he's lost his mind. They demand their money back. Some threaten to sue him. He locks the fund. They can't withdraw. For 3 years, he bleeds money watching his bet go red every single day. 2008 arrives. The crash. Lehman Brothers collapses. Bear Stearns disappears. The global economy implodes. Burry's fund returns 489%. He personally walks away with $2.7 billion. They make a movie about him. Christian Bale plays him in The Big Short. He becomes a legend. Then silence. 2 years of complete radio silence. No tweets, no interviews, no public statements, nothing. October 31st, 2025, Halloween, he returns to social media, posts a cryptic message with a scene from Star Wars. Sometimes we see bubbles, sometimes there's something you can do about it. 5 days later, the financial world discovers what he did, and markets lose their minds. November 5th, 2025, a single document gets filed with the SEC, Form 13F, Scion Asset Management Quarterly Holdings. Investors and analysts open the file expecting routine updates. What they find instead sends shockwaves through Wall Street. Michael Burry placed $1.1 billion in put options against 2 companies, not just any companies, the 2 faces of the AI revolution, Nvidia and Palantir. Let's break down exactly what he did. Nvidia, 1 million shares in put options, the underlying asset value, $187 million. But here's what matters. Nvidia just became the first company in human history to hit a $5 trillion market cap. $5 trillion. More valuable than the entire GDP of Germany. More than Apple at its peak. The company makes chips that power artificial intelligence. Every AI model, every data center, every tech giant's AI dreams run on Nvidia hardware. And Burry just bet against it with almost $200 million. Now Palantir, 5 million shares in put options. Total value, $912 million. Almost $1 billion on a single position. Palantir provides AI software to intelligence agencies, militaries, corporations. Their stock has been absolutely unstoppable, up over 300% in the last 18 months. Price to earnings ratio, over 400 times. That means the company is valued at what it would earn in 400 years. For context, the average S&P 500 company trades at 25 times earnings. Palantir trades at 16 times that multiple. Combined total, $1,099 million in puts. But here's what nobody's mentioning. Burry's entire stock portfolio, every long position he holds, totals about $283 million. That means he placed 4 times more money betting against these 2 AI companies than he has invested in everything else combined. 80% of his fund concentrated on one thesis. AI is a bubble and it's about to burst. We don't know the strike prices. We don't know the expiration dates. The SEC filing doesn't require those details, but the size alone tells you everything. This isn't a hedge. This isn't a small protection play. This is conviction. The kind of conviction that made him a billionaire in 2008. The kind that ruined everyone who bet against him. Markets opened on Tuesday, November 5th. The 13F filing goes public. Within hours, panic begins. Nvidia shares drop 4%. Doesn't sound like much until you realize that's roughly $200 billion in market cap erased in one day. Palantir gets hit harder. Down 8%, another $40 billion gone, but that's just the beginning. Wednesday and Thursday, the selling accelerates. Not panic selling, not headlines blaming Burry, just steady, methodical profit-taking, smart money recognizing the signal. By the end of the week, Nvidia is down 9.1% from its pre-filing peak. Palantir drops 15.5%. For the full week, Nvidia closed down 7.1%. Palantir down 11.2%. The Nasdaq had its worst week since April. And here's the number that matters. $685 billion in combined market capitalization evaporated across Nvidia, Palantir, and related AI stocks in just 72 hours. Traders started calling it the Burry effect. One man, one filing, one thesis, nearly $700 billion gone. But the market reaction is only half the story. Because while Nvidia stayed relatively quiet, the CEO of Palantir decided to fight back. Hard. Alex Karp, CEO of Palantir Technologies, known for his unconventional leadership style, his wild hair, and his absolute conviction that Palantir is building the future. Russia. November 5th, same day the filing drops, Karp appears on CNBC for an interview. The anchor asks him about Burry's position. His response? Shorting Palantir and Nvidia is batshit crazy. Not, I disagree with the thesis. Not, the market will prove him wrong. Batshit crazy. On live television, he continues, we're one of the very few companies actually making real money from AI. This isn't speculation, this is revenue, this isn't a bubble, this is transformation. Then he goes further, suggesting the move looks like market manipulation designed to scare retail investors. Now, Karp has a point. Palantir just reported third quarter earnings, revenue up 63% year over year. The company is profitable. Unlike many AI startups burning cash, they have contracts with the US government, with major corporations, with defense agencies worldwide. This isn't some meme stock with no fundamentals. It's a real business with real cash flow. But here's where it gets interesting. Despite those strong earnings, Palantir's stock dropped 7% the day after the earnings release, before anyone knew about Burry's bet. Why? Because investors looked at the valuation and couldn't justify it anymore. A PI ratio of 400 means you're paying for 4 centuries of future profits today. Even with strong growth, that's an enormous premium. The market was already nervous. Burry just gave them permission to sell. And this is where you need to understand something crucial. Burry isn't attacking the business. He's not saying Palantir or Nvidia are frauds. He's not claiming their technology doesn't work. He's saying the valuation has become completely disconnected from reality. That the stock prices reflect fantasy, not fundamentals. That we're in a mania, and manias always end the same way. So you have two titans. On one side, Alex Karp, CEO of a $470 billion company, defending his valuation and his vision. On the other side, Michael Burry, the man who made billions predicting the 2008 crash, putting his money where his conviction is. One says AI is the future and will justify every dollar of investment. The other says AI is real, but the bubble around it is catastrophic. Who's right? Let's look at what Burry sees that maybe we're missing. Before Burry filed his 13F, before anyone knew about his billion-dollar bet, he started sending signals. Halloween 2025. After 2 years of silence on social media, he posts, sometimes we see bubbles. The post includes images from Star Wars, memes about AI. Cryptic, vague, but clearly pointing at something. The next day, another post. Sometimes there's something you can do about it. Then a third. Sometimes the only winning move is not to play. 2 days later, the filing becomes public. He was warning us. He was telling anyone paying attention that he saw something dangerous and he acted on it. But what exactly did he see? Let's follow the money and the math. Start with OpenAI, the company behind ChatGPT, the face of the AI revolution for most people. Current annual revenue, $3.7 billion. Impressive growth, but annual losses, $8 to $9 billion. They lose more than twice what they make. Projections suggest cumulative losses could hit $129 billion by 2029 if current trends continue. Yet the company is valued at $500 billion. Why? Because investors believe future revenue will eventually justify it. That's not investing, that's faith. Here's where it gets darker. Industry experts, people like Julian Guerin from MacroStrategy Partnership, have calculated the AI bubble's size relative to the US economy. His estimate, 4% of US GDP. That might not sound massive until you compare it to previous bubbles. The 2008 mortgage crisis that destroyed the global economy, about 0.5% of GDP. The dot-com bubble that wiped out trillions in 2000, around 0.23% of GDP. If Guerin is right, the AI bubble is 8 times larger than the mortgage crisis and 17 times bigger than dot-com. Those bubbles nearly broke the financial system. What happens when something 8 times larger pops? Then there's the circular revenue problem. This one's subtle but devastating. Nvidia invests billions into OpenAI and other AI companies. Those companies then use that capital to buy Nvidia chips and infrastructure. Nvidia books that as revenue and shows explosive growth. Investors see the growth and pour more money into Nvidia. Nvidia invests more into AI companies. The loop continues. It looks like organic demand driving a booming sector. But what if it's just money circulating inside a closed system? What if external sustainable demand is far lower than the numbers suggest? When the investments stop, when the capital injections end, does the revenue collapse? Look at market concentration. Since 2022, AI-related stocks have driven 75% of the S&P 500's total returns. 80% of the index's profit growth came from AI companies. That means the entire market's health depends on one sector continuing to grow at an unsustainable pace. 30% of S&P 500 companies now trade above 10 times sales. The last time we saw that concentration, the year 2000, right before the dot-com crash, took the Nasdaq down 78%. Burry sees these numbers. He sees the circular revenue, the concentration risk, the valuations that require decades of perfect execution to justify. And he remembers history, because this isn't the first time he's watched smart people ignore obvious warning signs while chasing returns. Year 2000. The internet is going to change everything. Companies with .com in their name see their stock prices soar regardless of revenue, profit, or business model. Pets.com goes public, raises hundreds of millions, and collapses 9 months later. Amazon trades at 100 times sales. Analysts say valuations don't matter because this is a paradigm shift. Anyone questioning the boom gets called old-fashioned, dinosaur who doesn't understand technology. Then reality arrives. The Nasdaq loses 78% of its value over 2 years. Trillions of dollars evaporate, retirement accounts destroyed, careers ended. 2025. AI is going to change everything. Companies with AI in their presentation see valuations explode regardless of whether they have functional products or paying customers. Palantir trades at 200 times forward earnings. Nvidia becomes the first $5 trillion company. Microsoft invests $80 billion into AI infrastructure this year alone. Google adds $75 billion. Analysts say valuations don't matter because this is a paradigm shift. Anyone questioning it gets dismissed as someone who doesn't understand the transformation happening. Do you see the pattern? The structure is identical. Revolutionary technology appears. The technology is real and valuable, but speculation runs so far ahead of reality that prices become absurd. Early investors make fortunes. Late investors, the ones buying at the peak because they don't want to miss out, they're the ones who lose everything when gravity reasserts itself. But there's a crucial difference this time. In 2000, most dot-com companies had no revenue and no profits. They were pure speculation. Today, companies like Nvidia and Palantir are profitable. They have real businesses, real customers, real cash flow. So maybe this time is different. Maybe the valuations, as stretched as they are, will grow into themselves as AI adoption continues. Maybe Burry is wrong, except Burry has been early before. In 2005, when he started buying credit default swaps against mortgage bonds, the housing market was still rising. For 2 years, he watched his positions lose money while everyone called him insane. His investors revolted. They wanted out. He refused to let them withdraw, convinced he was right, even though the market said otherwise. He suffered through massive paper losses, personal attacks, and professional isolation. Then 2008 happened and he was vindicated spectacularly. But those 3 years of being right too early nearly destroyed him emotionally and professionally. Being correct about the direction doesn't matter if your timing is wrong and your positions expire worthless before you're proven right. That's the risk with Burry's current bet. Put options have expiration dates. If Nvidia and Palantir don't fall before those options expire, Burry loses everything he invested, 100% loss. It doesn't matter if the stocks crash 2 years later. Options aren't stocks, they're time-bound bets, and time decay is brutal. So what if Burry is early again? What if AI stocks keep climbing for another 2 or 3 years before reality hits? His options could expire worthless. He loses over $1 billion. Meanwhile, investors who stayed long make another 50 or 100% before the crash. Being right eventually doesn't pay your bills if you're bankrupt before eventually arrives. This is the genius and the curse of Michael Burry. He sees things others miss. He has the courage to act on massive conviction. But his timing isn't perfect. His 2023 tweet saying sell came right before one of the strongest market rallies in history. The S&P 500 is up roughly 70% since that warning. Anyone who listened missed enormous gains. So when Burry makes a bet this large, you can't just blindly follow. You have to understand what he sees, evaluate the thesis independently, and decide if your risk tolerance matches his. Because make no mistake, this is an extremely risky position. Now let's model both scenarios honestly. What happens if Burry is right? And what happens if he's completely wrong? Because your portfolio depends on understanding both possibilities. Scenario 1. Burry is right and the AI bubble pops within the next 12 to 18 months. What does that look like? First, you need a trigger. Bubbles don't just collapse randomly. Something breaks the narrative. Here are the most likely catalysts. Nvidia misses earnings guidance. The company has beaten expectations for 8 straight quarters. Revenue growth has been extraordinary. But what if demand for AI chips slows faster than expected? What if companies like Microsoft and Google announce they're cutting AI infrastructure spending because returns aren't materializing? Nvidia guides down for the next quarter. The stock drops 15% in a day. That's $400 billion in market cap gone instantly. Panic spreads to every AI adjacent stock, or OpenAI fails to reach profitability by 2027. Right now, they're burning billions per year. Investors tolerate it because they believe eventually the revenue will justify the losses. But what if it doesn't? What if by 2027 they're still losing money and the path to profitability looks impossible? Their $500 billion valuation collapses, every AI company gets repriced lower because the flagship just sank, or the circular revenue structure gets exposed. Investigative journalists or analysts dig deep and discover that 40 to 50% of AI sector revenue is just companies investing in each other and buying from each other. External demand is far lower than reported. When this becomes public knowledge, confidence evaporates. If the growth isn't organic, if it's artificial, the entire sector gets marked down. When the trigger hits, here's what happens next. AI stocks correct 50 to 70% from peak levels. Nvidia, currently at 3 trillion plus, falls to under 1 trillion. Palantir drops from 400 billion to under 100 billion. Every company that added AI to their business description to pump their stock gets hammered. The correction is violent and fast because leverage unwinds all at once. But it doesn't stop there. AI companies represent 75% of S&P 500 returns since 2022. When they fall, the entire index follows. The S&P 500 drops 30 to 40%. Retirement accounts take massive hits. Wealth evaporates across millions of portfolios. Venture capital funding for AI startups dries up completely. Hundreds of companies go bankrupt, layoffs sweep through tech. Crypto markets, which rallied partly on AI hype, crash in sympathy. Bitcoin loses 50%, Ethereum drops 60%. The entire risk on trade reverses. Money floods into bonds, gold, cash, volatility explodes, the VIX spikes above 70, trading halts become common as circuit breakers trigger repeatedly. And Michael Burry, his put options, depending on strike prices and leverage, could return 300 to 500%. That $1.1 billion bet turns into 3 to 5 billion in profit. He becomes the man who predicted 2 once-in-a-generation crashes. His legend grows even larger. That's scenario 1, painful for most, profitable for the prepared. But there's another possibility. Scenario 2, Burry is wrong. Not wrong about the technology, but wrong about the timing or the magnitude. AI adoption accelerates faster than even optimists expected. Companies find genuine productivity gains that justify the investments. OpenAI reaches profitability by 2027. Nvidia's revenue keeps growing because demand for AI compute is even larger than current supply. The bull case plays out. In this world, Palantir's 400 times PE ratio doesn't matter because earnings growth is so explosive that within 3 years the ratio normalizes. The company earns its valuation through performance. Nvidia pushes toward 10 trillion in market cap as AI becomes embedded in every industry. The stocks Burry shorted keep climbing. His put options expire worthless. $1.1 billion gone. Total loss? It doesn't matter that the stocks might crash 5 years later. Options have expiration dates. If the crash doesn't happen before expiry, the bet fails completely. Burry takes a massive public loss. His reputation suffers. Critics who called him a permabear pointed this as proof he's lost his edge. Meanwhile, investors who stayed long through the volatility make another 50 to 100% over the next 2 years. AI transforms industries. Healthcare, education, logistics, entertainment all get revolutionized. The technology delivers on its promise. The valuations, as stretched as they seemed, turn out to be justified by the sheer scale of change. This scenario is possible. Revolutionary technologies do transform the world. The internet bubble popped in 2000, but Amazon, Google, and the internet itself ended up being even bigger than the optimists imagined. They just had to survive the crash first. Maybe AI follows the same pattern. Bubble pops, weak companies die, but the strong survive and dominate for decades. So which scenario happens? Here's the brutal truth. Nobody knows. Not me, not you, not even Michael Burry. He's making an educated bet based on historical patterns and current valuations, but markets can stay irrational far longer than you can stay solvent. Timing macro calls is incredibly difficult even for legends. However, there is one indicator that can help you think about this more clearly. It's called the Buffett indicator. Total US stock market capitalization divided by GDP. It measures whether stocks are overvalued or undervalued relative to the actual economy. Historical average sits around 100%. During the dot-com peak in 2000, it hit 140%. During the 2008 crisis, it dropped to 60% before recovering. Right now, the Buffett indicator is above 200%, the highest it's ever been in history. That means stocks are valued at twice the size of the entire US economy. How did we get here? AI stocks driving the market to unprecedented levels relative to economic output. This doesn't guarantee a crash, but it does suggest the market is priced for absolute perfection. Any disappointment, any slowdown, and the correction could be severe. Another metric worth watching: the AI sector's price to sales ratio. Companies like Palantir trade at 50 to 100 times sales. Historically, any sector trading above 20 times sales has eventually corrected hard. We're well past that threshold. Again, it doesn't mean the crash happens tomorrow, but the risk is elevated and undeniable. So what do you do with this information? Panic and sell everything, ignore it, and stay fully invested? There's a middle path that's smarter than either extreme. Step 1. Open your brokerage account right now and calculate your exposure to AI stocks. Add up Nvidia, Palantir, Microsoft, Google, Amazon, Meta, any company heavily tied to AI growth. What percentage of your portfolio is concentrated there? If it's above 30%, you're in Burry's crosshairs. You're taking concentrated risk in the exact sector he's betting against. That doesn't mean you're wrong, but you need to be conscious of the risk. Step 2. Consider hedging. This doesn't mean selling your positions, it means buying insurance. Put options on the QQQ, the Nasdaq 100 ETF. Choose a strike price about 15% below current levels. Pick an expiration 6 to 12 months out. This costs you 2 to 3% of your portfolio value. But if Burry's right and AI stocks crash, those puts could return 10 times your investment and offset massive losses in your core holdings. You pay a small premium for significant downside protection. Step 3. Build cash. Aim for at least 20% of your portfolio in cash or short-term treasury bills. This isn't about fear or pessimism. It's about optionality. If markets crash, you have capital to buy incredible assets at massive discounts. If markets keep rising, you still have 80% invested capturing gains. Cash isn't trash when you're at all-time highs. Cash is opportunity waiting for deployment. Step 4. Diversify beyond tech. panic, add positions in sectors that benefit when AI spending slows. Energy, utilities, consumer staples, healthcare, these are boring, unsexy investments, but they hold value when growth stocks collapse. Balance doesn't mean missing out, it means surviving to win long term. And here's the key psychological shift you need to make. Stop thinking in terms of all or nothing. You don't have to choose between Burry is right or Burry is wrong. You can position for both outcomes simultaneously. Hedge your AI exposure while staying invested. Build cash while holding growth stocks. Prepare for volatility without abandoning the market. Remember Burry's own history. In 2005, he was right about the housing crash, but he suffered for 3 years before being proven correct. His investors hated him. They tried to pull capital, he locked them in against their will. His personal life fell apart under the stress. Yes, he made billions eventually, but the path there nearly destroyed him. Can you handle 3 years of being right but looking wrong? Can you stomach watching your hedges lose money while AI stocks climb higher? Can you resist the urge to capitulate at the worst possible moment? Most people can't. That's why most people lose money even when they identify the right thesis. Execution and emotional control matter as much as analysis. Let's talk about what you should watch for in the coming months. These are the early warning signs that Burry's thesis is playing out. Nvidia earnings reports. If revenue growth decelerates or guidance disappoints, that's signal 1. Pay attention to data center revenue specifically. That's where AI chip demand shows up. If that number softens, the bubble is cracking. OpenAI and Anthropic funding rounds. If these companies struggle to raise capital at previous valuations, or if investors demand profitability timelines instead of just growth, the narrative is shifting. Desperation for funding means the cash burn is unsustainable. Tech layoffs in AI divisions. If Microsoft, Google, Amazon start cutting AI research teams or slowing hiring, it means internal ROI isn't meeting expectations. Companies don't fire talent in areas they believe will drive future growth. Insider selling. Watch SEC Form 4 filings. If executives at Nvidia, Palantir, and other AI companies start selling massive chunks of personal stock holdings, they're taking chips off the table. They might know something the market doesn't. And finally, credit markets. If corporate bonds from AI companies start widening in spread relative to treasuries, credit investors are getting nervous. Credit markets usually see trouble before equity markets do. They're smarter and less emotional. If you see 3 or more of these signals within a short period, Burry's thesis is accelerating. That's when you tighten stops, increase hedges, and prepare for turbulence. But until then, the market can keep climbing and proving him early yet again. Here's what I want you to take away from this. Michael Burry placed $1.1 billion on a single thesis. AI valuations are unsustainable and a crash is coming. He might be right. History and math support his view, but he also might be early. And early in options trading means losing everything. You don't have Burry's capital or his risk tolerance. You probably can't afford to lose $1 billion and shrug it off. So don't try to copy his exact trade. Instead, learn from his process. He identified a massive risk that most people are ignoring. He sized his position based on conviction, and he's willing to be wrong publicly if the thesis doesn't play out. Do the same with your own portfolio. Identify your biggest risks, size positions accordingly, and be willing to adjust if you're wrong. That's how you survive long enough to win big when you're right. $685 billion evaporated in 3 days after Burry's filing became public. That's the power of one man's conviction shaking market confidence. Whether he's ultimately right doesn't change the fact that his bet moved markets. That tells you something important. The confidence in AI valuations is fragile. It doesn't take much to crack it. Burry saw the housing bubble in 2005 when everyone else saw prosperity. He was mocked, ridiculed, threatened. Then 2008 proved him right, and he made billions while others lost everything. Now he's staring at AI stocks the same way he stared at subprime mortgages, seeing catastrophe where everyone else sees innovation. Is this the Big Short 2.0? Will we look back in 2 years and call Burry a prophet again? Or will this be his Tesla moment, where he shorted too early and watched the stock soar? Time will tell. But one thing is certain, when a man with his track record puts down over $1 billion, you ignore him at your own peril. So here's my question for you. Drop it in the comments. Are you riding the AI wave higher, or are you hedging like Burry? Are you convinced this is a bubble, or do you think AI justifies every dollar of valuation? Tell me where you stand and why. And if you think I missed something critical in this analysis, call it out. Let's debate this in the comments. If this breakdown helped you understand what's really happening with Burry's bet, smash that subscribe button. We're going deep on market-moving stories that actually affect your money, not clickbait garbage. Hit the bell so you don't miss the next one. And if you want to support the channel, share this video with someone who owns Nvidia or Palantir. They need to see this. The Big Short happened because people ignored obvious warning signs until it was too late. Don't let history repeat itself in your portfolio. Stay sharp, stay skeptical, and I'll see you in the next one.